Okay, so this video will walk through a few of the Chapter 16 exercises on analyzing variances. So we have a master budget by Cherry Lawn at the beginning of the year was based on sales of 275,000 units with revenues of 3,300,000. Variable costs are budgeted at 1,925,000. Fixed costs are 950,000. During the period, actual production and actual sales were 255,000 with revenues, actual revenues of 3,442,500. An actual variable cost of $6.50 per unit and actual fixed costs of 980,000. So that's what you're filling in. So our flexible budget is at the current production level. So the 255,000 units. So the master budget here is at the 275,000 units. So then if we go down and we look at it, if our master budget is 3,330,000 and we're selling 275,000 units, we'd have a selling price of $12 per unit. If our variable costs are budgeted at 1,925,000 and we're selling 275,000, our variable cost per unit is $7. And then the fixed cost is the 950,000. So we need to take this $12 and the $7 and then multiply it by the 255,000 that we actually ended up selling. So 255,000 times the $12 gives us this $3,060,000. So again, the difference is 240,000, which would also be 20,000 units times that $12 because we sold 20,000 less units than we thought. Then our variable costs are going to be, again, the $7 per unit times the 255,000 units. So that gives us our variable cost. So that would be favorable again because we produce less. So obviously our variable costs are going to be less. Again, the 20,000 times that $7 is going to be that favorable variance. So then our contribution margin, again, sales revenue less those variable costs gives us the contribution margin. You could also calculate that by looking down here. Your selling price of $12 per unit minus your $7 variable cost provides you $5 per unit contribution margin. We sold 20,000 less, so that would be an unfavorable 100,000. Our fixed costs are the same, so really we're just an unfavorable 100,000 due to selling 20,000 less units. And then at this point, we're not factoring in, we're just doing the flexible budget. So we're not factoring in any of those actual ones in this particular problem. Now then here, it's the same scenario, but in more detail. So again, if we look at this here, now we do factor in the actual. So our flexible budget and our master budget are what we just calculated in that first exercise. Now we factor in the actual and say, okay, well now our actual sales revenue was 3,442,500. And then that is going to be for, let me go down here. How do we know how many units we have? Oh, okay, right there. Yeah, so go back. It was that it's the same thing. So it's a 255,000 actual units. Same thing we had in the last problem. So my mind kind of went blank on that. So then because the 255 resulted, if we had used the $12 per unit, that's what that flexible budget would have been. But we actually sold them for more than $12. So that would be a favorable sales price variance because again, we sold less than we expected, but we sold them at a higher price. So that's a favorable difference between what we actually came in as revenues and what that flexible budget would show. Okay, then our variable costs, the actual variable costs were $6.50 per unit. So $6.50 per unit times the 255,000 units that were sold gives us the 1,657,500. And then again, we compare that to our flexible budget, and it is also favorable. So then that means we did not incur the whole $7.50 or whatever it was from the one before it. So then, and then our contribution margin again is going to be favorable because we've got both our variable costs were a little bit lower and our selling price was a little bit higher. Then our fixed costs actually came in at 980,000, so those are unfavorable by the 30,000, and then that's going to offset the favorable variance that we have going on from the variable costs. So then that nets it though still to 97,500 favorable relating to manufacturing, 382,500 favorable related to a higher selling price. So our actual operating profits end up higher and are favorable. So then that factors in the actuals into that one. Okay, then our flexible budget, looking over this graph, so what is our budgeted fixed cost for the period? So our actual costs, the master budget is for 6,000 units of planned activity, and that would be our variable and our total. So it's just the 25,000, correct? Yes. So it's just right here. So even if we had zero production, the fixed cost would be 25,000. Then it increases based on that variable cost per unit. So then we would take the difference between the 61,000 total minus the $25,000 fixed, and then divide that by the 6,000 units to get to $6 per unit. So 61,000 minus the 25,000 divided by the 6,000 units gives us that $6. The value of the FB, the flexible budget, at 4,000, well, now we can put it into that formula that we did a few chapters back. So 4,000 times the $6 per unit would give us 24,000 plus our fixed expenses of 25. So our total costs are our fixed cost plus our variable costs. And then what if the flexible budget, what if the activity is 12,000 units? Again, same formula, fixed cost plus variable, 6 times the 12 would give us 97,000. Okay, then our variable costs variances. So this one definitely is going to get into a lot more detail because, this will be one you'll kind of want to focus on. But our direct materials are 3 pounds per case of pet food at $2 a pound. The direct labor is 0.25 hours at $32 an hour. Variable overhead is applied based on those direct labor rates. The variable overhead rate is $16 per direct labor hour. The fixed overhead rate is $12 per unit. All non-manufacturing costs are fixed and are budgeted at $2.2 million. At the end of the year, the cost analyst reported the sales activity variance was $336,000 favorable. And then they give us the actual income statement down below. So they want us to break it all out, again, based on the different efficiency variances. So if we come down here and look at these, I think this is the best thing to look at. So we are comparing our actual costs. So again, the actual costs are given to us there up above. So the 800,000. And then we're going to compare that to the actual inputs at our standard price. So $2 is our standard price, and then our actual inputs are 320,000 units. So, so they tell us, 320,000 pounds because we're in the materials. So 320,000 pounds. And then they tell us up here that, again, $2 a pound. So they give us that information to fill those in. So at the $2 a pound times the 320,000 pounds that we purchased, that's $640,000. So then that would be a $160,000 unfavorable price variance. We paid more than the standard price because the standard price would have resulted in 640,000. Then we focus on the quantity side. So our standard price times our standard quantity should have been 768,000. And then if we look at so they're not quite breaking it out. So they're just looking at then the difference to say, well, if our total difference is the 640,000, our actual inputs at the standard price compared to our standard inputs at the standard price. I guess they are doing it. So 640,000 compared to the 678,000 gives us 128,000 favorable. So we would have used less pounds than we had estimated. Then we take our actual costs and compare it to our actual inputs at the direct labor hours. So we had 32,500 direct labor hours, which they give us above there. And then our standard cost was $8, or sorry, it's $32 an hour, but then it's 0.25 of an hour. So let's see how they got that down there. So yeah, so it's already in the hours. So $32 an hour times the 32,500 hours gives us our actual input at the standard price. So then we have a favorable price variance. So we did not pay our workers the $32 an hour. Then we look at our standard price times our standard quantity and compare that to our standard price times our actual quantity, and we see that that is unfavorable. So we used more hours than we had estimated. So that's an unfavorable efficiency variance. Then finally, the same thing with our variable overhead. So that's our actual. Then our actual at the standard price is $16 per direct labor hour, gives us a 520,000. So then that is a $5,000 favorable variance. But then we take our actual inputs at the standard price times the standard quantity at the standard price and compare those, and we are $8,000 unfavorable. Again, we used more direct labor hours than we should have. So I think like that's the most important thing. If you can map those formulas out down there, again, I like how it is in the PowerPoint where it kind of goes across, like you have your actual and then your standard and at standard quantity at standard price. And then in the middle, you're going from actual to standard and then from, and then back the other way. I like how it's set up like in the PowerPoint, but obviously this still works and you get to the same answers. Okay, so spend a little time absorbing that one. And that should help you again with all the different questions, whether it's asking for material variances or labor variances or overhead.